Welcome to this explainer. Okay, today we are diving into an absolutely fascinating mystery. We're looking at applied optoelectronics. You'll hear them called AAOI, and they just dropped a blockbuster Q20 2026 earnings report that has the entire financial world buzzing. I mean, the numbers are huge, the stakes are incredibly high, and the market, well, it's completely divided on what happens next. To really understand the story, we've got to ground ourselves in the numbers first. Just 52 weeks ago, this stock was sitting at $18.50. It was a time of serious doubt for the company. And honestly, it's where this entire wild ride essentially began. And then, a spectacular swing, bam, $233.67. Talk about a roller coaster. This massive 52-week high perfectly illustrates the explosive volatility and sheer hype surrounding the stock over the past year. Investors were aggressively buying into the company's future, sending that valuation straight into the stratosphere. Which brings us to right now. The dust has settled a bit, and the stock is hovering right around $124. This sets up the central question we're exploring today. Is this current price a unique buying opportunity, like a genuine bargain, or are we staring at an overinflated bubble that is just preparing to pop? Okay, let's dive into this. Section 1, the Q2 blockbuster, breaking down the earnings. To really pull back the curtain on their Q2 performance, we have to separate all that hype from the hard numbers. AAOI just achieved its 5th consecutive quarter of record revenue. They posted $191.9 million, landing comfortably at the higher end of their guidance. But here's the real kicker. They reached a major turning point by returning to non-GAAP profitability with 6 cents earnings per share. That completely beat expectations. Now, we do have to note they still posted a GAAP net loss of $22.8 million, mostly due to non-cash charges. But their overall cash position, it remains incredibly strong at over $508 million. Section 2, AI data center demand, the engine of growth. So what exactly is the engine behind this massive 86% year-over-year revenue surge? Well, it's the sheer dominance of one sector, the AI data center segment, taking up 56% of the pie at $107.7 million. This segment grew an astounding 140% year-over-year. It is completely dominating their revenue makeup right now. But, don't ignore their KTV segment either. That side of the house is still hitting records and providing a solid $80.6 million, which nicely diversifies the business away from being just a pure AI story. But within that AI data center slice, that's where we see the real hypergrowth. Take the 800G product line. It brought in $12.8 million in Q2. That might seem kind of modest at first glance, but management projects this single product line is going to explode to between $62 and $65 million in Q3. We're talking about nearly 5 times sequential growth in a single quarter. This kind of frantic demand curve leads to a fascinating reality, and it's summed up perfectly by CEO Thompson Lin. He stated that their near-term revenue is bounded almost entirely by production capacity and key component availability. So the absolute crucial point here is this. We're no longer looking at an AI demand story. This is entirely a physical manufacturing and supply chain challenge. The customers are already there. The company literally just can't build the products fast enough. Section 3, the capacity race, a $500 million bet. This is a literal race against time. Current reports indicate demand is running 20 to 40% above what AAOI can actually supply, and they are scrambling to close that gap. Right now, they can produce nearly 200,000 units per month of their high-end 800G and 1.6T products. By the end of 2026, they expect to more than triple that to reach 650,000 units per month, and by the end of 2027, they're targeting an incredible 930,000 units a month. The sheer physical production build-out required to satisfy these impatient customers is just monumental. So how are they physically executing this expansion? It's all happening in Texas. They're expanding to a massive 1.6 million square foot footprint in the greater Houston area. Late in Q3, a 210,000 square foot facility in Sugar Land will open up, and it's completely dedicated to these new transceivers. Plus, they're adding 400,000 square feet across 2 new facilities in Pearland. More than half of that massive 2027 capacity target will come directly from these Texas facilities. Of course, building out that kind of massive physical footprint definitely doesn't come cheap. Just listen to this number, $565.5 million. That was their capital expenditure for Q2 alone. And $280 million of that was just for equipment prepayments to fuel this physical expansion. Management is making a massive bet here. You don't commit $500 million in capital unless you are seeing rock-solid long-term demand signals from your clients.
Section 4. The Bear Case. Reality Check.
Now, as an objective market observer, we absolutely have to weigh these bullish indicators against some significant risks. First up is valuation versus reality. The stock price currently sits around $124 after a massive 200% year-to-date gain. But analyst fair value estimates, they're sitting way down between $20 and $78. We're looking at a highly elevated price-to-sales ratio compared to industry averages, which leads some to strongly argue the stock is fundamentally overvalued right now. And then there's the internal signaling. Over the last 90 days, insiders have sold 506,000 shares worth $87.4 million. Crucially, this includes key figures like the CFO and a director taking their profits. When the people closest to the company are cashing out at these levels, you know it is a major red flag for the bears that simply cannot be ignored. Finally, let's talk about the guidance. While top-line revenue is undeniably growing rapidly, bottom-line profitability is scaling a bit slower than Wall Street had hoped. The company's Q3 EPS guidance of 11 to 26 cents actually missed the analyst consensus of 27 cents. Now, this is partly due to a $20 to $25 million hit from 100G switch memory shortages that impacted a key customer. So the growth is absolutely there, but supply chain headwinds remain a very real threat to their margins. And this brilliantly illustrates the other side of the coin. Section 5, the bull case, the U.S. manufacturing advantage. Optimists are completely brushing off those bear concerns, and they're doing it because of a massive geopolitical edge. Think about it. Potential U.S. restrictions are looming over Chinese optical components. In that landscape, AAOI's status as the largest U.S.-based manufacturer becomes incredibly valuable. Early customer feedback suggests AAOI could capture a huge chunk of market share simply by providing a secure domestic supply chain. Add to that what we call the laser advantage. Having in-house indium phosphide laser production gives them a phenomenal competitive edge, especially while the rest of the industry faces severe supply constraints. Furthermore, they've already secured their substrate supply through late 2027 across 5 different qualified suppliers. This makes their manufacturing highly resilient to the exact types of shocks the bears are so worried about. Section 6, the ultimate Q4 test, the monster quarter. Everything we've discussed is leading us to this climax. We are looking at a virtually unprecedented growth cadence for the optical industry. We go from Q2 actuals of $191.9 million, jumping up to a Q3 guidance midpoint of around $272.5 million, but in Q4, based on informal management guidance of roughly $330 million in combined 800G and 1.6T revenue alone, the implied total revenue lands at a staggering $480 to $500 million. They are essentially attempting to double their Q3 revenue in a single quarter. And what's fueling the back half of that massive Q4 jump? Well, the new 1.6T product line is just waking up. Over $200 million in 1.6T orders have already been secured, with shipments starting this very quarter and an even larger ramp-up poised for 2027. Which brings us right back to our original premise. Bargain or bubble? Can AAOI actually deliver? Q4 is definitively going to test whether AAOI can scale their physical production fast enough to justify this incredible valuation. The demand from AI data centers is undeniably real, but it all comes down to execution. Will the new Texas facilities pump out enough transceivers to hit that $500 million quarter, or will supply chain snags just pop the hype? $500 million rests on exactly what happens in Texas over the next 180 days. Thanks so much for joining us for this explainer, and we'll see you next time.